I'll stick on this view for now, obviously, which isn't ideal. But yeah, please let me know if it doesn't update going forward. I tried to maximize this as much as possible. So obviously at the start of winter, or kind of end of October, we did see quite a big ramp up in prices. Obviously, put to kind of smaller scale on this graph, we had winter risks starting to materialize really. So forecasts of colder temperature and low wind through November, and at the time we were getting actually quite low LNG imports. So kind of those two features drove up a bit of premium. We still had lots of uncertainty around the Ukraine-Russia gas transit agreement as well. All that premium quickly got eroded right at the back end of the month. Now, again, kind of a double whammy, milder revisions coming in, so that previous cold didn't really materialize. Temperature forecast came in milder, but we also had another fake news story. If you remember back in September, we had the first fake news story about the Ukraine gas transit agreement, which caused this big drop in prices. We had another one right at the back end of October, which quickly got found out to be incorrect. It was previously reported by Bloomberg. And then the market focused on the overall kind of tighter picture at that time. So high storage withdrawals due to higher demand, the weather coming in a bit colder, the real kind of start to winter. Those LNG imports, again, just were not ramping up at the time. That fleet was kind of stuck more to the Asian side. The Asian prices were premium to Europe. And therefore, we didn't really get enough supply, withdrawing storage at very high rates. And more kind of geopolitical news. So we had OMV, which is kind of Austria's main gas buyer. They won an arbitration victory over Russia's Gazprom. The market thought that with immediate effect, Russian gas being delivered through Ukraine and eventually to Austria would stop. That was fairly small volumes, only 0.17 terawatt hours per day. But in a tight market, every bit of supply matters. That actually didn't happen. That supply actually continued right until the end of the year, but that market kind of uncertainty obviously drove a risk premium. We saw another big turn, really big turn in the market through the first 2 weeks of December. Again, we had more kind of geopolitical news on the Russia-Ukraine gas transit agreement. So this time it was actually positive sentiment regarding Ukraine gas transit. Those Slovak PM Robert Fico engaging in intense talks on the gas supplies. So he was a big advocate of continuing the gas transit deal, lining up different talks across different parties. There was also talks at the time potentially they could do a Azerbaijani-Russia gas swap deal to keep those flows coming. And I suppose to put it in perspective, due to the overall tight market, without that kind of stable Russian pipeline supply into Europe, and at seasonal normal temperatures, the market was saying we need to be priced in the high 40s on TTF. With that supply continuing, it probably dropped down to the mid 30s. So it was really kind of a binary thing. If we had those flows continuing, you would have the gas price drop quite sharply below 40. So in this period, where really kind of the likelihood of gas continuing ramped up, we saw that big drop in prices, people factoring in potentially more of a 50-50 chance instead of a 95% against. On the 16th of December, pretty much where we hit the bottom of the market in December, we had the European Commission come out and state they had zero interest to continue Russian gas flowing through Ukraine. Obviously, Hungary and Slovakia were kind of the two countries vying for it. The EU Commission overall didn't want to continue that gas transit agreement. And then on the 19th of December, so a few days later, you had both separately, Putin and Zelensky state transit can't continue past the end of the agreement. So that obviously gave the market a lot of confidence. Those Russian flows would stop going forward. And that's exactly what's happened over the last few weeks. Obviously, at the back end of December, with that confidence, the market ramped up and up. We had obviously a period of low liquidity over that Christmas week. And essentially, it was just kind of that the bullish drivers from Ukraine gas transit stopping and longer term forecasts of potential colder weather risks in January. So the market getting a bit concerned around the overall tightness in 2025. Now, since, it has been quite a roller coaster so far this year. Big kind of sell off over the first week or so, picked back up, but as you can see, massive kind of daily swings. Lots of things happening in this time. We've had obviously a cold snap at the beginning of January. Longer term forecasts at the time were showing very mild, so kind of going to 3-4 degrees above normal in Europe from mid-Jan, lasting all through February. When you got close to delivery, those mild temperatures kind of erased out, and we stayed fairly seasonal through that time, cold in the UK. And I think that's happening at the moment as well, where longer term forecasts were looking at a very mild February. Just overnight and kind of the morning run today, we've had that completely erode out, and we've had colder temperatures on the horizon. Geopolitically, there are some talks going on about potentially bringing Russian gas pipeline through Ukraine back, some Azerbaijani deal as well, which Zelensky mentioned over the weekend. We've obviously had Trump come into power, talking about peace deal with Russia, Ukraine. So lots of things that potentially could happen. At the end of the Biden presidency, we did have also stricter sanctions on Russia. I suppose the one which mattered to the market most is particularly targeting 2 of the Russian LNG facilities after the 45-day wind-down period. So at the back end of February, we're losing about 3 BCM to the global balances for this year. So lots of moving parts on the geopolitical landscape, which could kind of move it in either direction. And see fundamentals, longer term forecasts were mild, they've all been revised down. So it's been a moving part. Generally the market is just focusing on overall tightness and getting through the rest of winter, see how much of the gas storage stocks we are going to use. Now, one of the most interesting dynamics we have seen over this time is the summer 25, winter 25 spread. So this is looking at the TTF price again. Now, the chart is just showing the price difference between the two. And if I explain it, a negative price, if you look at the axis, negative price means summer 25 is priced at the discount to winter 25. Positive means that it's moved to a premium. Now, in a rational market, the summer should always be discount to the winter, because essentially you've got to incentivize gas storage sites to refill in the summer and withdraw in the winter. If you have that summer at a premium, there's no incentive. So you wouldn't inject in the summer because there's no money to be made out of it. There's only losses to be made out of it. Now, EU regulation states that we have to get, or Europe has to get to around 90% storage by the 1st of November. With that mandate and potential penalties in place, and what we've found out recently is potential subsidy scheme as well, that summer price has gone to premium. So with us relying on gas storage stocks quite a lot, it's going to be a task to refill for this summer. But as we have to get to that level, that summer price has shot up in comparison to that winter price. So now pricing, I think if I updated it today, it would be just over the €5 per megawatt hour mark. So again, it'd be interesting how this dynamic evolves over the next few months. If we did see significant loosening of the market and we weren't really worried about tightness of supply anymore, this spread would go back to negative. As it stands, the current outlook, we have to have a premium summer price to attract all the LNG to the European hub away from Asia in order to reach the targets. The one thing I would say on this, I think the consultation by the German gas operator, we should find out a bit more detail over the next, within the next month, I would say, around kind of the price targets they would subsidize. And our view is essentially the spread should kind of gravitate to whatever max spread they're going to set in the regulation. So looking at fundamentals, so first off, in European storage, as I alluded to, we have been withdrawing at a far higher rate than usual. So this is just looking at storage stocks. As I say, we inject through summer, so the first kind of half of the graph, and we withdraw through winter. You can see the previous two years, so summer 22, winter 22, and summer 23, winter 23. We've reached very high stocks to start winter, and we've experienced very mild weather as well as demand destruction, obviously back a couple of years ago. And you can see we've ended March at very good stocks. you don't really have that much gas to put back in to get to full ready for next winter. And that's why, obviously, beginning of last year, we saw that big bearish pressure on prices really come off. Summer 24, winter 24, so our kind of current year, we did reach pretty much full stock levels, around 95%, not quite as high as last year, but the rate we've been withdrawing has been much higher. You can see pretty much from November up until now, we've withdrawn obviously at a far greater rate. That's on that overall kind of colder temps versus the last few years, that lower LNG, particularly over November and December, or sorry, October and November. And obviously going forward, we are going to, even if we have a seasonal or very slightly mild February, that's still going to be colder than previous years as well. So we're already below storage levels versus the end of last year. The view is we're going to end at around 450, give or take, terawatt hours, all dependent on weather and LNG supply over the coming months, which puts a very tough task on actually refilling to that 90% level to begin winter 25. And that's just to highlight, this was a snap just taken a few days ago, so this will have changed slightly. But yeah, 184 terawatt hours delta versus last year, and as I say, already below where we finished last March, and we're expecting higher withdrawal rates over the next 2 months versus last year as well. So potentially that delta will grow between 200 and 250. European LNG imports, so this is just showing by month and kind of where that supply is coming from, starting in January 23. I think what we want to really focus on here, we know we had less LNG come in summer. We didn't really need all that LNG because we didn't have that storage refill requirement. We filled up to 95% with kind of that lower LNG. But to start winter, so in that October-November period, it didn't really ramp up as much as it should. So with that slightly cooler temps year on year, and this lower LNG, that's kind of what kind of led to us utilizing storage a little bit more. So that obviously kick-started the kind of bullish drive over the last few months. December and January have been much better, so we can see lots more LNG is coming to Europe. So January, I think the highest month since last year, since January or December last year. And obviously going forward, we are expecting quite a tick up again in February. Now, what is going to be important for the European market is keeping that supply coming in. If the market got comfortable with it and prices dropped and we went back to discount versus Asia, that supply can quickly turn away again. So we need to sustain these high LNG imports throughout summer in order to refill our storage goals. 1 or 2 months isn't going to quite cut it due to how much of a deficit in storage we are year on year. And just, I suppose, what I was alluding to there, so it's really a competitive market on the global energy landscape. So what we're seeing here is kind of the global prices. So you've got Henry Hub delivered cost at the bottom, nothing to worry about. US price is obviously very cheap. Competition between Asian and European prices, so Asian shown in the blue, European shown in the orange, that is key to monitor. We did see in beginning of November, we went to a slight premium over Asia very briefly. Asia then picked back up, that competition again driving both hub prices up again. More recently, we actually have seen the European price go to quite a staggering premium over Asia, and we have kept it as well. And so that's why we're seeing potentially lots more LNG coming over the next few weeks. What is going to be important is what does the Asian price do? Asia really has to be a slight premium to us to attract those kind of steady flow of cargoes from the US. It is looking quite cold across Asia over the next couple of weeks. However, we are in the Chinese New Year week, so demand is typically lower now. So how that evolves over the coming weeks is obviously going to be key. If that competition drives back up, both hubs will be pushed up. If we continue to see a premium, we're going to have lots of LNG kind of flood into the European market and obviously ease some supply concerns. Now, just on, so this is actually looking at US LNG feed gas across several of their LNG facilities. Really, what I wanted to touch on here was the bottom left one, Freeport. So we probably talked about it a few times in this webinar before. Freeport have had constant issues over the last few years with shutdowns due to cold weather or several other circumstances as well. So you can see kind of their feed gas dropping out substantially at times as well. We have had that happen so far this year as well. So that polar vortex cold weather sweeping into the US, obviously down to Texas over the last couple of weeks, did cause Freeport to go offline. So right at the right-hand side of that chart, you did see it kind of drop back. However, not quite the same issues as they saw last year, where it was a prolonged outage, quickly bounced back when the temperatures picked back up. The other thing to call on here is the kind of the middle right one, so Plaquemines. So this is one of the new LNG facilities, and as you can see, really ramping up production or feed gas from December onwards. And this is kind of one of the things that we're expecting to continue to ramp up through this year and deliver more LNG at the back end of 2025 going into 2026. So that's why the market is mainly concerned around tightness this year. When we look into 2026, there's obviously lots of other concerns and geopolitical concerns, demand concerns to think about. But in terms of LNG supply, that should ramp up quite drastically from next year. And then just on temperature delta to normal. So I don't have the comparison to last year, but this is just looking at temperatures in kind of key European hubs. So we got UK, Germany, and France versus the 30-year normal. And I say the 30-year normal because if we use more of a 7 or 10-year average, that seasonal normal is probably pushed up almost a degree or so. We did start winter at fairly mild temperatures in October, but since we have seen more kind of seasonal and particularly cold at times. So December obviously quite mild for the UK. January has been a bit more seasonal for Conti and cold for UK as well. Year on year, it is much cooler. That's obviously what's driving that higher reliance on gas storage. At the same time, I don't have the chart to show it, we have had very low wind at times as well. So obviously that drives additional CCGT demand, so additional gas demand for power generation. So overall, you've had higher demand from heating, but also higher demand for power generation year on year. So as I said, there's lots more details. We didn't touch on spark spreads at all on kind of the power market. Obviously, if you do have questions on that, feel free to ask at the end. But just to summarize, overall, it is a fundamentally tight market, and there are uncertainties ahead. I'm sure probably wanting a bit more clarity from webinars like this, but that is the situation we're in at the moment. Weather forecasts in both Europe and Asia are set to be key in driving sentiment over the coming weeks. As I said, we've just had a sudden shift to colder temps in Europe forecast over the next 2 weeks. Asia as well, looking cold over that time as well. If that did reverse and go mild, that would put some downward pressure on. LNG arrivals obviously set to ramp up in February with that European premium. Competition is going to be really key this year. So monitoring that Europe-Asia spread is going to be important all throughout the year. We saw European stocks obviously relied very heavily so far this year. We're sitting around 185 terawatt-hours delta to last year, which was record highs. We're on track to get down to potentially up to 250 terawatt-hours below last year. Obviously, always depending what the weather supply situation is over the next 2 months. It's going to be a very steep challenge to refill to 90%. And obviously, we're going to have to price in Europe, price that summer premium to the winter with those kind of policies in place in Europe. Geopolitically, headlines are going to continue to drive volatility. We've already seen it this year. We've had Ukraine transit halted on the 1st of Jan. We have more recently had some more headlines come out. So Zelensky over the weekend said he can do a deal with Azerbaijan to deliver more gas. We're a little bit skeptical about that, only because Azerbaijan don't really have the capacity to ramp up. I think they could only really ramp up about 2 BCM of supply more immediately. Obviously, they could do more in the longer term. That would probably be enough for Moldova, but it's not anything significant to help kind of sort out the market tightness we're seeing right now. We do have the European Commission and FICO having some talks tomorrow about the resumption of Russian gas through Ukraine. Again, not too sure if that is going to be possible until we get a potential peace deal between the two countries. Energy sabotage, obviously still a concern. I put very low risk on this, but we did have a headline saying TurkStream was supposedly targeted earlier this year by Ukraine. So that's the compressor station based in Russia. Again, as I say, very low chance something like this happens, but the impact, if it did, would be massive. If TurkStream, which is a massive pipeline into Europe, goes offline, you're looking at another energy crisis. However, I do say very, very, very low probability that does get taken out. And obviously, I haven't mentioned Trump. Obviously, Trump's taken power now in the US. He could have a big prices. I think it's anybody's game to call what he's going to do. He's threatened further sanctions on Russia if they don't kind of help the peace deal, which obviously would be more bullish to prices. Obviously, there is a peace deal on the cards this year that could see further flows return either through pipelines or less kind of sanctions on Russian LNG facilities. So essentially more supply to the market, which again would be bearish. So lots of uncertainty there. What we do know is Trump is very big on drilling, drill baby drill. We should see more LNG obviously come into the market towards the back end of the decade. So again, you get past the tight market over the next year or two, then you should have more LNG kind of flood into the market there. That's all from me. Hopefully gave a high level overview, but yeah, if any more detailed questions, let me know.
Thank you, James. We did have some actually pre-submitted questions around Trump, so maybe I'll start with those. I think maybe one might have a bit of uncertainty around still, but what is the impact of Trump withdrawing from the Paris Climate Agreement on energy prices?
So yeah, I think that is, I suppose, the relation to our markets is potentially more towards the back end of the decade. So that kind of unleashing more US LNG onto the global market. If that, when that comes on, that should be bearish. Now, yeah, it depends how many years away that is. Yeah, overall should be bearish in the longer term.
Okay, thank you. So I'll take the questions as they come in. So apologies if they're in no particular order, but this was another pre-submitted one. So UK price impact views, given French nuclear gen was 56 gigawatt, highest in 6 years, but interconnector capacity is reduced currently? Question mark.
Yeah, so what we have seen over the last year plus is French prices have been typically lowest or kind of lower in kind of Northwest Europe. That's due to all kind of the French, very high French availability, and they are generally net exporters to their neighbouring countries. Obviously, we do have quite a few gigs of interconnect capacity with France. I know EFA kind of 1 and 2 have had some outages over the last few months. Typically, obviously, we've been importing. So when there are an outage, we need to then source that extra 1 or 2 gigs from elsewhere. And that will be typically more expensive generation, so gas-fired generation or so. So yeah, I suppose in times of stress, it will be, it is quite bullish on prices. See, going forward, if we're looking kind of more at the summer with the high French output, and typically imports into the UK, it should obviously add just extra cheap supply to our system.
Okay, thank you, James. Thanks to everyone who submitted questions ahead. So I'll go through the live ones now. So we've got, do you expect the amount of LNG imports in Europe coming from Russia increasing if Trump is able to broker a peace deal with Ukraine and Russia this year? And how do you think this might impact the pricing?
I think this, it's a very, very good question, very tricky one. Obviously, we have heard from the European Commission they do want to essentially sanction or kind of get rid of Russian LNG imports altogether. Now, the question is, do they still pursue that with a peace deal? And that seems to be kind of where they're heading. I know Ursula von der Leyen, I think she again came out last week and said, they are discussing that. Potentially, we'll get a bit more information on that over the next month, maybe on the anniversary of the Russia-Ukraine war. They'll come out with another kind of package of sanctions or so. Europe did want to, I suppose, ease kind of the phase out of Russian LNG. So it wouldn't be this year, they'd be looking to phase it out from next year. So that obviously should coincide with all the US LNG coming online. So Russia will have to send their gas elsewhere other to Europe. So it shouldn't really have too much market impact. If they do, it's in that stage. Obviously, if they came out and said we're sanctioning Russian LNG effective immediately, that would be extremely bullish prices for 2025. Obviously, if there is a peace deal and we continue with Russian supply and the sanctions don't come in, obviously that's just more supply to the market overall.
Okay, thank you, James. So the next question, on the EU storage chart, it looked as though this year was actually tracking in the middle of the 2018 to 21 range. Therefore, why is the market reacting so negatively? And could it not just be that previous 2 years there was abnormally high storage?
Yeah. So obviously, good observation. If you go back to that range, you had very stable supply. So you had, several hours per day of pipeline supply coming in from Russia. So very well supplied market. So you weren't in a tight situation. At the moment, it is a tight supply situation. You don't have that stable pipeline supply. You have to vie for that LNG imports coming in, and therefore you have to compete with other big demand hubs. So yeah, it might look like we're only in the middle of the two ranges, but the supply we've got coming into Europe is far less stable than it was a few years ago.
Thanks, James. Next question. What impact are all the speculative positions on ICE having on gas prices?
Yeah, very big. Obviously, we know funds, with all the volatility of the last few years, funds have been much bigger players in the European gas market. I believe their positioning on TTF gas got up to around 270 terawatt hours, which is massive. So yeah, they can definitely move the market around, and I think that's what obviously, along with all the uncertainty and kind of tightness in the market, the moves we've seen over the last year potentially have been exacerbated due to how many speculative players are involved. I expect that to continue. They like volatility. They get attracted to volatile markets. But it's definitely one to keep an eye on is kind of their positionings. And I suppose as they're still sitting very long at the moment. If you did see a big shift in fundamentals where stuff loosens up for some reason, say it's peace deal with Russia, Ukraine, more supply to market, whatever it could be, you suddenly then have a lot of players having to unwind those positions. But yeah, no, that definitely one to monitor a lot more versus say a couple of years ago, as that their positioning can move prices a lot more than it used to.
Thanks, James. So next question, why are gas prices for summer 2025 higher than the winter 2025? And what might cause this to revert to the usual differential?
Yeah, so that is what we discussed. That is just the European mandate to refill storage levels to 90%. If you didn't have that mandate in, the market would typically price winter at a premium to summer. So as long as it looks tight to refill storage for this summer, that premium will remain due to that regulation, and potentially, as I said, to come is a subsidy scheme. So European state gas storage buyers are going to be subsidized to kind of pay that summer premium. The only way for that to reverse, aside from EU removing that regulation, which they're not going to do, would be for the market to significantly loosen up. But obviously, as we're already at the back end of Jan, we've got a fairly good idea of what storage levels are going to be at the back end of winter. You would need something significant of extra supply coming to market.
Thanks, James. Did we have any other questions? I think we might that'd be all we've got then. Just give it a quick refresh. No? Okay. Oh, well, thank you, James. It was very insightful as always.